Good evening, all. I, CA Zoeb Nasruddin Mulani, Chairman Satara Branch, welcomes you all. Respected dignitaries on the dais, esteemed members of the profession, ladies and gentlemen, a very good evening to all of you. On behalf of Direct Access Committee of ICAI, it gives me immense pleasure to welcome you all today's live webinar on Overview of Returns, Assessment and Appeals under Income Tax Act 2025. We are truly privileged to have among us eminent personalities from the profession who have made remarkable contribution to taxation and professional development. To commence today's program, I would like to introduce our Vice Chairman of DTC Committee, CA Pankaj Shah sir. Sir is distinguished chartered accountant with expertise in direct taxes litigation and business restructuring. He is a fellow chartered accountant, company secretary, LLB honors, insolvency professional, and registered valuer. He has delivered more than 1,000 technical lectures and seminars across the country and is widely respected for his deep technical knowledge and practical insights. I would also like to introduce our chairman, sir, our very own Chitle sir, Chairman Direct Taxes Committee. Chitle sir is a senior practitioner in direct taxes and a legal drafting with decades of rich professional experiences. He has served as a central council member of ICAI across multiple terms and has significantly contributed to the profession through leadership in direct taxes, peer review, quality review, and various important committees of ICAI. Under his leadership, the revised guidance note on tax audit under Section 44 AB was brought out after a gap of 8 years. Sir has also authored several professional publications and articles and is widely admired for his contribution towards the strengthening the profession and mentoring the members. Now, I would like to introduce our today's speaker. It is my profound privilege to introduce our esteemed speaker for this session, CA Rajendra sir. Rajendra sir is renowned authority in direct tax litigation and advisory. He has had an illustrious professional journey spanning several decades. After leading his own practice, he served with EY and later with SR Botley and Associates LLP affiliated with EY, where he handled complex direct tax, international tax, and transfer pricing litigation matters. Presently, Sir is serving as a president of Income Tax Appellate Tribunal Bar Association for the year 2025-26. He has contributed extensively through professional article, technical publication, and lecture across ICAI branches and professional forums. Sir's rich practical experience and command over litigation matter makes him ideal person to guide us on the evolving framework under the Income Tax Act 2025. Sir, we are grateful for your valuable time and presence today. May I now request CA Rajendra sir to kindly address the gathering and begin the technical session. Thank you, sir.
Thank you, Zoe, for the kind word of introduction. Am I audible?
Yes, sir.
So, dignitaries on the dais and the dignitaries on this webinar virtual mode, my special thanks to Shekhar Chitale sir, Chairman of Directors Committee, that he has given the opportunity to share my knowledge, because unless otherwise it's a compulsion for us to make to appear for the exam. We don't like to read the material or go to the study material, and therefore in one sense, if this opportunity would not have been given to me, probably for next 6 months or 1 year, I may not have referred to 2025 Act. Otherwise, so after the age of 60, it's very difficult and there is no enthusiasm to read something new. But from that perspective, I think therefore I am thankful to Chairman sir and on ICAI committee for giving me the opportunity, so that I started looking into the provisions of the 2025 Act. The initial time set is from 4 to 6, and that the topic was designed as a returns, assessment and appeals. At that time, we were not aware that how many changes are there, whether 2 hours are enough, 1.5 hours is enough, 1 hour is enough. So suppose if there is no material and I'm likely to finish within 15 minutes, so consider that the CA final paper is tough and students are leaving the examination hall within 15 minutes. That kind of scenario. Of suppose if I go for 1 and 1.5 hour, 50%, 60% of the time set, then consider my performance at a 40% mark. And if I could not complete my paper up to 3 hours and requires, then I don't know whether I'm successful or unsuccessful, and again I prepare for the exam. So different scenarios. Anyway, in a lighter vein, let me turn to the topic proper. I'm giving the to present some amended provisions on filing of income tax return, where shortly we will be turning to the season of filing the returns and tax audit, etc. So from that perspective, I think it's a right moment to deal with the topic. With this, I'm requesting my colleague who has helped me to prepare this presentation, C. Kushal Agarwal. At the beginning itself, I convey my thanks to him that because of his efforts, this is possible. Otherwise, it was very difficult to prepare in a short period as such. Let me begin with that we all are aware that Honorable Finance Minister in her budget speech for Union Budget for 25-25 announced a comprehensive review of the Income Tax Act 1961 to make the income tax law concise, lucid, and easy to understand. So words looks very impressive. That act is going to be very concise, very lucid, and easy to understand. Now, concise means the information which has been flagged in the public domain, that the wordings have been reduced from more than 50, less than, I mean, more than 50%. Suppose there were the 10 lakhs words in the earlier Act 1961 Act, then the present Act, the words are brought down or reduced to even 4 lakh or something like that. It's just a comparison, less than 50%. Number of schedules and number of provisos, explanations, or sections have been reduced. So size of the act is reduced. Now, just because reducing the size, whether it has become really, it may have become concise, but whether it's a lucid and easy to understand, the experience will tell us, and time will tell us. Nobody today is in a position to whether the really the objective is achieved or not. So going forward, when we'll file the returns for the tax year 26-27, thereafter when we'll face the scrutiny of the returns and the matters litigated in appeal thereafter, will really itself the test whether the objective is achieved or not. If the same quantum of the litigation is going to be there, then obviously it cannot be considered as a fulfillment objective. But let's to end on the positive tone that really the objective of the government is fine, and really from the general public perspective, the attempt is most welcome. And from that perspective, and as far as our role as a practicing chartered accountant, etc., concerned, certainly we are known as a for contributing for the nation building, and therefore definitely whatever our share of responsibility is there, we will definitely face as a fraternity as such. And with this, let me proceed with the topic for today. uh, just to understand the difference in the language, whether the complications have gone down or really it is a lucid, concise, etc. I was comparing the provisions in the 1961 Act, and that is the taxation of the charitable trust. Earlier, this taxation of charitable trust, which was basically compartmentalized in only three sections, section 11, 12, 13, followed by some rules, rule 17, etc. And it was a full-fledged topic divided into the three sections as such. Later on, from 2009, then 1421, there were a lot of changes in this provisions of the tax. while talking informally, it was for many of us, it was difficult to handle the case of charitable trust as an audit as such, or the filing of income tax return assessment, or taking for approval under section 12A, 12B, or 80G, etc. So most complex set of provision. Once upon a time, I recollect my days that at many ICI branches, etc., I used to deliver the lecture on the taxation of charitable trust. But after 1421, etc., a lot of changes, and the topic has become, according to it's my personal view, that the topic has become very, very complicated. So I was comparing the provisions of section 11, 12, 13 of the 1961 Act and the present set of provisions under the Income Tax Act 2025. The corresponding provisions have been inserted and appearing in section 332 to section 355 of the Act. And those are found to be suitably divided under various subheads as follows. For example, section 332 talks about the application for registration. Then section 333 talks about switching over the regimes. Then section 334 talks about the tax on income of the registered NPO. Now, registered NPO is the terminology which is now substituted all other charitable trust, public trust, religious trust, fund, institution, etc. So now registered NPO is, I think, a common terminology used, and that is a form of simplicity or lucidity, that the provisions have been, from that perspective, has become easy to understand. So tax on income of the registered NPO is governed by section 334. Then regular income of this registered NPOs, which talks about section which is provided in section 335. Then taxability of the regular income, section 336, and then specified income, section 337. Then income not to be included in the regular income of the registered NPO. Then what is meant by corpus donation? Earlier we used to deal with this under section 11, the donation with a specific direction, non-specific direction, whether corporate donation is capital receipt or exempt, that kind of scenario. So corporate donation is now dealt with section 339. Then what is deemed corpus donation? Application of income, accumulation of income. Application of income is 85% of the income is to be applied for the charitable or purpose. Accumulation of income up to 15% or more than 15% by filing certain forms, that is accumulation of income, to continue the exemption of the charitable trust. Then what is meant by deemed accumulation of income? That is, suppose the income is not received in cash and the trust is following cash system of accounting, or the income is accrued, suppose it is following mercantile system of accounting, but the income is not received. And the point in case of charitable trust, that if the income is not received, then it is not possible someone to spend. So really spending requires the availability of the funds. So can it be that accrual of income can be taken as a deemed accumulation of income? Then commercial activity by registered NPO, business undertaking held as a property of the trust. Then what is the restriction on the commercial activity by the registered NPO? Restricting that if the commercial activity where the gross receipts are less than particular threshold or above threshold, that is some kind of restriction is placed on the commercial activity to be carried out. Then restriction on by registered NPO for carrying out advancement of any other object of general public utility, which is the most controversial decision, and the rulings of the Supreme Court we all are aware in case of the HUDCO. Then books of accounts to be maintained by the charitable trust or now registered NPO, section 347. Then provisions governing the audit of the registered NPO is stated in section 340. Return of income, section 349, because earlier for the charitable trust or institution under section present set of 1961 Act, there was a separate section provided by virtue of section 139 4C, and now it is the return of income of the charity, non-profit organization NPO is considered by section 349. Then permitted mode of investment, that is earlier section 11 subsection 5, which are prescribed the different mode of the investment for the charitable trust. and now which is governed by similar section, corresponding section to section 350. Then what are the specified violations? Say if the investments are not made as per the prescribed mode of section 11.5, as section 11.5, or some undue advantage or benefit is given to the person, so like the trustee or a contributor about certain amount. So where the mainly the provisions are violated, and section 13 once he comes into the picture, that if the some violations are made, then the exemption will be withdrawn. That kind of certain violations were prescribed. Then tax on accredited income, I think section 115p of the present act. Then other violations. Then approval application for approval for the purpose of section 133 1b, which is now corresponding to section 354. Then merger of NPOs, amalgamation of the NPOs, that is charitable trust, which is now dealt with by section 354A. So the entire chapter with a proper heading and really easy to understand, because earlier we felt that section 11, 12, 13, there were three sections, but that was divided into so many provisos and subclauses and explanation that really it was very difficult for us to understand the whole chapter as such. So comparatively, as the presentation of that section in the 1961 Act, vis-a-vis if it is compared today as a non-profit organization provisions, then I think that is in the right direction, that the act seems to be simplified, concise, and easy to understand as such. Then there are certain terms which are very important in the context of the taxation of charitable trust, that is now NPO, and these definitions are given. That is, for some terms are defined. What is meant by anonymous donation? What is meant by approval? What is meant by cancellation of registration or cancellation of approval? What is meant by donation? What is meant by commercial activity? What is meant by registration? Then registered NPO. What is meant by related person, which we had talked about section earlier, section 13(1)(c). Then relative. Then what is residual income? What is specified asset? What is meant by specified person? Specified provision, value, and the last but not the least, wholly for charitable or and religious purposes. So various terms are now found to have been defined under this chapter, and since these terms now provide a clear-cut meaning, so obviously there will be lesser litigation, and provision of the law can be followed or even implemented, leading us to the lesser litigation. So this is one example which I considered just to show the difference between the old provision, complex set of provision, vis-a-vis now the present avatar of this section. Now, since my first subtopic is regarding returns of income, I just first, I think the difficult task is to recollect these sections of the 2025 Act. So I think we will be required to spend 6 months or so, or depends on one's capacity of the memory. But corresponding section of 25 Act and 1961 Act, I think that it will be at the initial days, unless we practice this law for some period, it will be very difficult and likely to create a confusion. For example, in the old Act, section 263, which talks about the revision by the commissioner of the orders which are prejudicial and erroneous and prejudicial order for the department. So revision of assessment order, that is very common, 263, and very well known section, very well litigated section, and we are quite aware of this. So section, similarly under old Act, section 264, that is the instead of appeal, if you want to litigate something, so not and a better option for appeal is not better as such, but alternative remedy if one doesn't want to go through the review or revision by the commissioner or on the application made by the assessee, then 264 provision where remedy for alternative route for appeal as such. But now section 264 or 2025 Act is talking or providing for something else. So these are the sections, like section the return by whom it is to be verified, or payment of self-assessment tax, or payment of tax for updated return. These are the various sections which are renumbered, and it will require some sort of time to get adjusted with this new set of provisions. And therefore, this comparative this on an illustrative basis, this is given that section 139, now new section 263, which talks about the return of income. Section 139D, filing of return in electronic mode. 264, scheme of submission of returns to the tax returns preparers. Section 140, return by whom to be certified, verified. Section 266, payment of self-assessment tax. 267, tax on updated return. So these are the sections, corresponding sections, which we now need to recollect and deal appropriately. When the as compared to the, if our memory probably when I given the example of 263, so we will not be able to recall that now section 263 is talking something else. So it will require some time to pass, and therefore we have to get familiar with these provisions. So this apart from the contents or the complications or the textual matter to be understood, this is the numbering of the sections to recall, which also be a task for us for a few days. Now, so this example of 216 139 already given. Now the section 139 of the present act provide that the term every person who is liable to file the return of income has been expanded. The 1961 Act has referred to a company or a firm or a person other than a company or a firm who is required to file the return of income, and then different circumstances in the case of section 139, subsection 3, subsection 4, subsection 5, subsection 4C, etc. are prescribed. For example, 139.3 talks about the return of the loss, or 139.4 talks about the belated return. 139.5 talks about the revised return. So different circumstances, but the person, every person who is liable to file the return, were prominently divided in the part that company, a firm, or a person other than a company or a firm. As again this, as per my understanding, the now section provides for a company, a firm, a specified entities who were earlier covered under section 139 4C, university or college or other institution, business trust, investment trust, a person who has sustained a loss under the head PGBP or capital gain and who intends to claim the carry forward of the loss, a person who is a non-ordinary resident, and a person who hold a beneficial ownership, including the financial interest or any asset outside India, or who is a beneficiary of an asset located outside India, whose income is liable to be included in the hands of the beneficial owner. So now the obligation or the person liable to file the return is, I think, the properly elaborated in a very wider manner, rather than in the circumstances. Now these persons are held as a liable to file the return. So there is maybe in substance there will not be many change as such in the setup of the act, but some more clarity that these are the different kind of organizations who are required to file the return of income. This is the one change, I think, which I thought it fit to brought. Then the earlier this list was bifurcated in various subsection, which I just briefed about it, and now it is this entire list has been brought under one subsection. That is the change which I noticed. Then on further analysis, it is observed that some aspects of obligation to file the return of income from the act are lifted and placed or shifted in the rules. So earlier that provision was in the act itself by way of proviso or explanation, etc. But now these aspects have been shifted to the rules, Income Tax Rule 2026. For example, as per the present 7 proviso of under 1961 Act, 7 proviso section 139, which provides that a person was required to file a return if a cash exceeding of rupees 1 crore is deposited in the current account maintained with a banking company or a cooperative bank, or in a case where the expenditure exceeding rupees 2 lakhs, expenditure incurred on consumption of electricity exceeding rupees 1 lakh, or other conditions as may be prescribed. If these are the circumstances, then the person is liable to file the return. This was the part of the act, that is, it was placed as a proviso in the section itself, in the act itself. Now, all these conditions are now shifted to Rule 163 of the Income Tax Rule 2026. This is a change. Now, one can say that how does it really makes a difference whether a particular scenario is dealt in the act or in the rules? But I think from the litigation point of view, it makes a lot of difference. And how I will cite one example for this just after 2 minutes. So now the issue is there may be a legal consequences that a particular provision is lifted from the act and embodied under the rules, because we are aware that rules are always considered as aid for interpretation of the statute. At the same time, the proposition is also tendered and which is accepted and settled proposition of the law that the rules are subordinate to the act or the rules cannot override the law. However, in the present scenario, that lifting of the certain conditions and imported it into the rules is an attempt to simplify the act. Whether it's a attempt to simplify the act or it will have some implications on the litigation, that is a question mark, and that we have to look at it. For example, actually for a common man, it doesn't make a difference whether conditions are prescribed in the statute or it is prescribed in the rules. That will not make a difference for the layman. But for the litigator or the practitioner, for us or the litigators, we know that how the rules placement of certain thing under the rules and under that make a difference. I recollect one old scenario that where valuation of the perquisite under the furnished accommodation and furnished accommodation was brought in Rule 3. And I think there were a lot of challenges and lot of litigation. So thereafter, that provision of valuation of perquisite, which was there in Rule 3, that has been brought under the Act. And because of the placement of that provision in the rules was not coming to the rescue of the department, and there was some sort of litigation is my as per my memory. So for litigator, whether a particular provision is placed under the rules or under the act, that makes a difference. But however, this is the scenario that in the present act, certain conditions where the obligation to file the return is imposed on the person, that has been lifted from the act and shifted to the rule 163. Such kind of scenario may be considered as simplification, or we don't know whether it will give birth to the another chapter of the litigation that the time will tell us. Next. The very practical importance for us is the change in the due date of filing of the returns of income. Now, as you see in the table, there are 4 due dates. So probably our work pressure will get divided, and to that extent there will be relief for our fraternity. The filing of the returns and due dates are corresponding like this. For all cases, whether transfer pricing cases are there, where the compliance under the transfer pricing provisions are required, the due date of filing the return is 30th November. Then company other than the applicability of transfer pricing provision, the due date is 31st October. Person other than a company whose accounts are required to get books of accounts audited under this Act, Act 2025, or any other law, say Societies Act or Charitable Trust Act or any other law, 31st October. Partner of a firm whose accounts are required to be audited under this Act or under any law, again 31st October. Assessees having income from profits and gains of business or profession and books of accounts are not required to be audited. For them, the due date is 31st August. The reason for given is that normally for computation of the income of PGBP, there is, as compared to the other positions of salary or house property or income from others, some more time is required to be given to the assessees who are offering income from PGBP because of the particular set of computational provisions, and therefore some additional time is given for them, that is from 31st July to 31st August. Then partners of a firm whose accounts are not required to be audited under this act or under any other law, for them the due date is 31st August, and any other case is 31st July. Now I was just wondering what could be the other case. Probably this will cover only the case having the having the income from other heads except the PGBP. So for them, the due date is 31st July. So this is the first immediate. We are concerned with this provision, as very soon the return filing season is going to commence. So this is the change which one is required to note. Here, just a minute, just go. Here, one point which from the litigation perspective, when particularly a particular activity is falling under the business or profession, this is important because for calculating the turnover limit for the SSE, if it falls under the business, then the turnover limit is something different, say 1 crore or 2 crore or whatever it may be. If the activity falls under the profession, then the tax audit limit is say 50 lakh rupees. Now, sometimes the activities, nature of activities like this, that there can be litigation, there can be debate, that the assessing officer says it's a profession or business vice versa, and therefore it shifts the applicability of the tax audit. For example, if I consider the activity falling under the profession and the receipts are rupees say 60 lakhs, then I say that I will advise that the profession, if it is considered as a profession and the revenue receipts are exceeding 50 lakh rupees, so tax audit is required, and therefore due date of filing the return is extending to 31st October. AO took a view that no, this activity is not a profession, it's a business. And for business, the tax audit limit applicable is 2 crores. Your receipts are 60 lakhs. So you are not required to file the, you are not required to comply with the provisions of the tax audit. And therefore, the due date in your case is 31st August and not 31st October. I think the point is very clear. For profession, the threshold of turnover for tax audit is at a lower level, while threshold for tax audit applicable in case of business is at a higher degree of the turnover. Now, if the activity is considered as a profession by the assessee, so he will take as a due date as 31st October. But the AO alleges that it's a business activity and tax audit is not applicable, then according to him, the tax audit, the return filing date will be forwarded to 31st August. And it will have a lot of implications on revision of interest, belated interest, setup of losses, etc. So therefore, and very common examples which I've seen, that say the activity of the beauty parlor or the say activity of recruitment agency, etc., where the recruitment agency or placement agency is helping the companies registered with them for placement of the employees. Now the debate is whether it's a activity falling under the profession or under a business. Or suppose there is a case of a multi-specialty hospital, that so many doctors are coming together and they are rendering services under the one roof. A hospital is established with a whole machinery and every individual doctor is contributing something and they are sharing the receipt. Whether it's a business adventure or just because it is based on the doctor's specialized skills who are well educated, and still it can be regarded as a profession. And there are many case laws available as on today for this, Lucknow Tribunal and several other cases, where it is very difficult to hold it as a whether a particular activity is a business or profession. For that purpose, the mainly the rulings have held that when the activity is falling and the criteria of say medical, engineering, technical, architecture, etc., or any specified profession read with rule 6F of the presentation 44 AA, then that will be called as a profession. If the activity is not falling under the specified activity, say engineering, architecture, medical, technical, consultancy, etc., then all other activities, maybe it may be a service industry, like I gave the example of the placement of recruitment agency. Then just because it's a service, that does not mean it's a profession. It can be called as a business. And therefore, from this borderline cases, one has to be very careful what is the threshold of the tax audit which is applicable, because ultimately that is going to decide the due date of filing of the return. And I think this is the important point. Under the new act also there is no separate clarity as such, and we have to live with the old litigation on this point. But I think it was a right time to discuss, because the due date is accordingly get shifted if the particular activity is falling under the caption of business or of a profession. Next. Then extension of time limit for revision of interest, section 263 subsection 5, that means old section 139 subsection 5, that time for filing the revised return is extended by 3 months. Earlier it was up to December, now it has been extended to 31st March. So we are getting the 3 months extension. Then belated return can be filed up to 9 months, because earlier the revised timeline for filing the revised return and filing the belated return was sitting on the same fencing, and therefore the belated return was not possible to revise. Now, since the belated return time is up to 9 months and revised return is extended by 3 months, so now the belated return can also be revised for the within the extra time allowed of the 3 months, and that is the, I think, welcome provision. However, any relaxation of this kind is coming with certain additional economical burden on the SSC. Now they are saying that we will impose the fee for filing the revised return beyond 9 months. So at the first thought, we say that the time is extended, but this liberalization or relaxation time of 3 months is coming with the additional cost, and that cost is termed as a fee, not an interest or penalty, but it is called as a fee, statutory fee. So therefore they are saying that if the total income filed in the revised income exceeds rupees 5 lakh rupees, then the fee shall be 5,000. And if the total income is less than 5 lakh rupees, then the fee shall be 1,000. It is provided in section 428 subsection B of the 2025 Act. So this relaxation of 3 months has come with an additional burden or the fee to be imposed under the Act. This may kindly be noted. Then there is some important welcome change in the provisions related to filing the updated return. Section 263 subsection 6. Earlier 139 subsection 8A, it has barred filing the updated return if there is a reduction in the case of the loss, or the loss is getting increased as such, then updated return was not allowed to be filed, or even where the notice for reassessment or reopening is issued under section 148, then updated return was not allowed to be filed. Now the provisions have been relaxed that updated return in case of reduction of loss is allowed, provided the original return declaring the loss has been filed under section 263(1) that is old section 139(1). For example, in the original return, you have declared a loss of rupees 10 lakhs, and now under the updated return, you want to declare the loss of rupees 8 lakhs, reduction of the loss. Then this is permissible as per the amendment in the Act. The only condition is that original return must have been filed in the original time limit set in section 139(1), that is corresponding section 263(1) of the 2025 Act. Then earlier updated return was not allowed to be filed once the notice under section 148 of Income Tax Act 1961 was issued. Now, as per the new Act, the updated return is allowed to be filed within the time limit prescribed in the reassessment notice issued under section 280 of the Income Tax Act 25. However, again this relaxation has come at a cost of 10% of the further additional tax. The additional tax was span over 25% to 70%, as the case may be. That's 24 months, 36 months, 48 months. Now, in addition to that, there is a further levy of 10% of additional tax if you want to file the updated return after issue of notice under section 280 of the new Act, that is old version of the 148 of the 1961 Act. These are the two provisions which have been have impacted the filing of updated return under section 139(8)(a), that is present section 263 subsection 6. So this was all about the filing of the returns. Beyond this, I have not noted any changes which will be essential to discuss in this forum. And if something is left out from my side, then obviously we can discuss it at the end of the session, and so that my information will also get updated. But this is from my perspective, that was the changes relevant for the purpose of filing the return. Now, second part of my presentation is regarding the assessment proceeding, provisions regarding the assessment proceedings. We are aware, and we have been practicing these sections which are given on the extremely left hand side of my PPT, that section as per 1961 Act, section 142, which talks about the inquiry before assessment, which has been now replaced by section 268 of 2025 Act. Then 142A, that is the provision relating to the valuation of asset by the DVO, and which is now replaced by section 269. Section 143.3, measure our bread and butter, which is now replaced by section 270, assessment. Section 140 is replaced by section 271, base judgment assessment. Section 144A, base judgment assessment. 144, which contains the provision of the for giving the directions by the Joint Commissioner, which is incorporated in section 272. Section 144B is governed by now section 273, which talks about faceless assessment, and 144C, that is corresponding section 275, which talks about the reference to the DRP, Dispute Resolution Panel. Section 147, corresponding section 279, income escaping assessment. Section 140 is replaced by section 280, issue of notice where the income has escaped assessment. Section 148, capital A, then corresponding section 281. 148 is post 1421 procedure before issuing the notice under section 280, that is notice under section 148AB, then calling for the reply of the SSE, then passing the order under section 144 AD, and then final culmination in issuing the notice under section 148. Then 149, which talks about the time limit for issue of notice, that is corresponding section 282. Then section 150, now replaced by section 283, which talks about the provision for cases where the assessment is in pursuance of an order or an appeal. This is the something, there is some change regarding the time limit, which I'm covering in my next part of the presentation. Then section 151, where the sanction for the issue of notices by the authority, specified authority, Then section 152 replaced by section 285, other provisions of the Act. Section 153, which is again a very important section, setting out the time limit for completion of the assessment, reassessment, and recomputation. Section 286 of the 2025 Act. Then section 154 replaced by section 287, which talks about the rectification of the mistake. Section 155, other amendments, which provide for other amendments, say the firm is assessed and there is a then implication on the share of profit or remuneration or etc. allowable to the partners. Then several subsections have been provided or for the TDS credit etc. Which are governed by section 155. Section 156, notice of demand, having a very implication on the appeal filing process. 156A, that is section 290, modification or revision of notices in certain cases. And section 157, section 291, practically I have not seen any compliance with this provision where the intimation of loss is to be given by the AO. So these are the sections. So almost all present sections are again incorporated in section 285, but we are told that now it is easy to understand, to see, or setting lesser complexion as such. So we have to see and what are the changes that we are going to deal with. Please note, in my presentation, I have not touched upon the assessment related provisions for search and seizure assessment. For the two reasons that search and seizure is a complicated and separate topic as such, we need to be understand very carefully, and it will require or there will be justification to devote a separate session for this. Therefore, I have excluded and I have taken that liberty to exclude these provisions from my presentation, not to deal with the search and search related assessment provisions, but other than search and seizure, I tried to cover to the best of my ability. So this may kindly be noted. Now, just a minute. Now, under the present act, there is a one hot controversy which is going relating to the time limit for completion of assessment, considering the provisions of section 144C, that is going through the DRP route, and the time limit set for completion of assessment in case of transfer pricing cases, that is section 153 of the 1961 Act. Many of us, I'm sure, whether practicing in the transfer pricing or not, must have definitely come across the decision of Roka Bathrooms of Madras High Court. So in this case, the controversy is not set at rest. It is still going on. And even the tribunals, even today, are adjourning the matter. And because the finality is yet to be achieved, and therefore this is the major controversy. And there is some change in the 2025 Act regarding this issue. The issue is like this: that there are two time limits set for the assessment. Section 144C, governing the provisions of the DRP mechanism, had set the time limit by virtue of section 144C subsection 13. And there is a another set of time limit for completion of assessment where the transfer pricing provisions are applicable, and that is in under section 153 of the Act. The controversy is rather whether the time limit prescribed under section 153 is applicable for passing the draft assessment order or the final order. This is the controversy. Department is saying that the time limit set in section 153 is the time limit applicable for passing the draft assessment order. So if the draft assessment order is passed within the time limit set in section 153 and thereafter the whatever the time limit is prescribed under section 144C13, then that is leading to the completion of assessment within the time, and there is no, it cannot be said that the assessment order is time barred. While the assessee's contention is that the time limit set in section 153 is the final time limit. That means it is not applicable to the draft assessment order, but draft assessment order, and after giving to the DRB's order, whatever the final assessment order is passed, that is to be passed within the time limit set under section 153. This is the controversy. And this time limit so is to be read from section 144C13 of the 1961 Act, is to be read independently or independently of section 163. The Honorable Madras High Court decision in the case of Roka Bathrooms Products Limited, 140 taxman, under SLP granted by the Honorable Supreme Court in CIT versus Roka Bathrooms, 147 taxman, may kindly refer for this controversy. Further, there is a shelf drilling Turkmere case, 153 taxman, Bombay High Court, followed by the split verdict delivered by the Honorable Supreme Court in the case of ACIT International Tax versus Shelf Dealing, 170 taxman. Under the matter is yet to reach the finality. Still, it is not. So, relating to this controversy, the lot of matters are pending at the tribunal level or the High Court level. Next. So, to overcome this decision of Madras High Court and subsequent litigation in case of shell drilling, etc., the section 275 and section 286 has been amended. The amended provides like this, that anything contained in section 286, that is old Act section 153, where a draft proposed order of assessment under section 151 is forwarded within the time allowed under section 153, that is 286, the further time limit period available to the assessing officer to complete the assessment under subsection 3 shall be governed by the provisions of this section, that is section 275. This amendment is brought with an intention to end the litigation following the decision of the Roka Bathroom and Shelf Drilling case. It is also important to note that Income Tax Act 1961 is also amended by the Finance Act 2026. So there are certain provisions where the Income Tax Act 1961 is also amended by virtue of the Finance Act 26. Related to this controversy, 144C13 or section 153, the amendment in Income Tax 2025 by virtue of amending section 275 has also been correspondingly amended in Income Tax Act 1961 by insertion of subsection 4A of section 144C13. So it's not that to end the litigation, only the change has been brought in section 275 or 276, but 1961 Act also has been amended by inserting subsection 4A of section 144C13. So the cases which are pending at a different levels of the appeal, etc., and which will be governed by the provisions of section 1961 Act are also going to be affected because of this amendment brought in section 144C13 subsection 4A of that. This is the important point which should have been which should be noted. Next, just go back to earlier slide. However, I could not lay my hands, but I came to know that this kind of amendment which has been inserted to amend the 1961 Act provision has been challenged before the Karnataka High Court by filing the writ, etc. I tried to carry this search whether I get any update on this, but I did not get any exact case name or other details, and therefore I'm not very sure whether this kind of amendment by way of section 144C13 4A is challenged by operate or not is I'm not very sure, but we can continuously look for the update because it's a very significant provision which is going to have the impact on the pending litigation before the various levels. So this is important, one has to note. However, at the same time, this amendment of section 275, 286, or by insertion of section 4A under section 144C13, it may save if the tomorrow the courts held that this retrospective amendment is not possible as it is causing prejudice to the substantive right of the assessee. It is creating a substantive, imposing the substantive liability, and therefore retrospective amendment is not possible. But this will be applicable to the pending cases. However, going forward now, where new cases will come up and where the question will come up whether the final time limit as per section 283, which is corresponding to the old section 153, will apply, or section 275 and old version of 144C13 will apply. I think we need to take a now call that it will be it has to be read that the Roka bathroom is not the good law from that perspective. Therefore, for pending litigation, relying on Roka bathroom and subsequent decision is fine. But going forward, what are the new cases regarding this time completion of time limit will arise? We have to certainly take into account the provision amended by virtue of section 275 and section 286 of the Act. This is the point which I want to convey. Next. Similarly, another major piece of litigation is regarding whether the notice issued under section 148 of the 1961 Act, as per the scheme under section 151A of 1961 Act, where the assessment procedure is revamped and the faceless assessment regime has been brought, and one-to-one physical interplay, etc., interaction with the department for facing the assessment, etc., is set to end, and a new scheme of faceless assessment or appeal has been brought. However, there are many cases where the section 148 jurisdiction has been assumed at the first level by the jurisdictional assessing officer, that is non-faceless officer, and later on, after receipt of after conducting the preliminary inquiry under section 148A and calling for the reply of the assessee B and passing the order under section 144D and final issue of notice under section 148, then after that the proceedings have been handed over or transferred to the faceless officer, that is FAO. So question arose whether the first step of assumption of jurisdiction by the ZAO, when the act or the scheme make a specific provision that it should be in a faceless manner, or the FAO, whether the notice issued is valid or not. And if the notice is invalid, then obviously the subsequent emanating assessment proceedings are also bad in law. This is the scheme of the act, or this is the challenge. So from that perspective, the matter has first, which landmark judgment of the Bombay High Court, it has come in the case of Hexaware Technologies Limited, 162-1.com. And the point has been decided in favor of the assessee that the ZAO, that is Judicial Assessing Officer, is not authorized to assume the jurisdiction, while the department all along is arguing that there is a concurrent jurisdiction between the ZAO and FAO, and therefore the notice issued is a valid notice. That is the contention of the department. The matter has not reached finality, and during this wave of litigation, the Income Tax Act 2025 is set to amend by virtue of section 279 and section 281, that is corresponding to section 148 and 148A of the Income Tax Act, which provide that for the purpose assessing officer for the purpose of section 280 and 281 shall mean an assessing officer other than NFSC, that is Presence Officer, or any other assessment unit referred to in section 273, subsection 3, that is earlier section 144B, subsection 3 of the Act. This is the amendment to overrule the decision of the Hexaware Technologies. From that perspective, the Finance Act 2026 has also amended section 147 capital A, which talks about, or which reads as that not written any dash 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 for the purpose of section 148 and 148A shall mean and shall always be deemed to have meant that the assessing officer other than NFSC or other assessment unit referred in section 144B3. So this is the amendment that they want to correct the action which was initially wrongly initiated. However, again, from this perspective, amending the act with retrospective effect, the rates have been filed, and according to me, the point is not the has not reached the finality, and the litigation is still going on. A lot of cases are pending. However, this is the amendment which we need to consider and for further litigation after the enactment of 2025 Act, whether there is a Hexaware law will not obviously apply because the new act is coming into the force. So this is the important amendment which one need to take into account. Just Indra, a break for 1 minute. Next. Then next important procedural change is authentication of electronic record. It is to be noted that section 144B subsection 6 under 1961 Act, there is a provision to authenticate the electronic record by affixing the digital signature of the authority who is issuing the notice or issuing any document, letter, etc. And this provision is on the statute from 1422. The Finance Act 2026 has amended section 144B 6 subsection C, that now the assessment unit or verification unit or technical unit or review unit shall authenticate the electronic record by way of an electronic communication, and the requirement of affixing DSC is removed. Though I have mentioned in my presentation that the requirement of affixing DSC is removed, I just want to make a small correction that removal is not directly coming from the act. So here don't take the literal meaning, but if you see the whole background of this amendment, one can say that the requirement of DSC is removed. But my apology to that extent, that it is the clear wording of that requirement of affixing the DSC is removed is to be taken with a pinch of salt. It is not exactly worded in that section, but as I discussed, that it says that the authentication of record will be by only communication of what is that exact wording? Just a minute. Electronic. Instead of that, the wording used is just a minute. Just let me share with the wording that has come in the act. it says that, and it is under 144B subsection 6, under clause Roman 1 subclause B, that assessment unit, verification unit, or technical unit, or even as the case may be, by way of an electronic communication. So the electronic record shall be authenticated by way of electronic communication, and they are saying that this electronic communication is substituted for by affixing the digital signature by the Finance Act 26 with effect from 1/4/22. So they are saying that you cannot challenge any approval or any communication as such if there is a no digital signature as such. So very in a liberal way, I use the word that DSC is removed, but actually that is not coming. But if you look at the intention of the wording of the amendment, it is indirectly leading to that you, even if it is not digital signature is not affixed, that particular document may not be treated as invalid. So in a sense one can say, however, rule 176, which is in this context, there also they have not used the word that requirement of DSC is removed. It is, they are not saying so. It is only saying that affixing requirement of affixing digital signature is replaced by way of electronic communication. This change, I think, but it's very important change, because in the non-faceless, when there was a non-faceless era, this signing of the notice or order, signing by the person who is passing the order or issuing the notice, was very important. And if the notice is unsigned, then it does not have the authenticity, and that notice is held as invalid, and all proceeding emanating from that notice will also be treated as invalid, because it is not giving the proper jurisdiction to conduct the assessment. And therefore, in non-physical, faceless mode, what was the importance of the signing of the document? In digital scenario, DSC was the same kind of thing. But now, if you say that affixing of DSC, that requirement is not there, that means as if you are saying that in physical mode the signature is not required. So whether it can be treated as a very valid amendment, and really, or still it will pose some challenge, that one need to look and wait and watch. But this is the provision which has been amended. So one cannot take a chance to argue that if the DSC is not there, the notice is invalid, because this amendment may create a problem. And from that perspective, amendment is section 144B subsection 6 of 1961 Act and corresponding Finance Act 2026, and amendment in Rule 176 are important before posing any challenge in the litigation. Next. Then we in this faceless manner or ITBA portal, just look how which are the different stages, the way in which the notice is being issued. Section 280 or 148 is amended by inserting subclause C, that when the assessing officer issues a notice under section 280 or order under section 281, that is order under section 148A, the period specified in the notice should not be less than 30 days and shall not exceed the 3 months from the end of the month in which the notice is issued. So now it is providing section 280, which is amended now. It has been providing the time limit for filing the return, etc. The minimum time limit not less than 30 days, but maximum time limit not exceeding 3 months. While in the old provision, prior to this amendment, there was a provision providing minimum time limit. Sorry, there was no provision. There is a typing error in my presentation. Prior to this amendment, there was no provision providing minimum time limit, only maximum time limit was provided. So under old act, only maximum time limit is provided, but now under the amended act, minimum time limit of 30 days and maximum time limit not exceeding 3 months has been provided. Now when AO issues the notice, the following scenarios or different stages one has to take, and this is also a challenge before the Delhi High Court in case of Sumit Agarwal, that how to reset the validity of the notice. The notice passes through the different stages as follows. First, the date on which the notice is generated on ITBA portal. Second bullet, the date on which the notice is signed. Third, the date on which the DIN is generated. Fourth, the date on which the notice is issued or dispatched. Then the notice on which the date on which the notice is served. So there are these 5 bullets which one has to consider, that which point should be taken for computing the limitation period to decide the validity of the notice. Date of generation, date of signature, date of DIN, date of issue, or date of service. Go ahead. In the old jurisprudence, when there was no NFSC kind of thing or ERA, there was no question of generating the notice as such on ITBA portal or electronic mode, or there was no formality prescribed for quoting any DIN number as such. Therefore, in the old jurisprudence, the validity of the notice was mainly challenged from 3 perspectives. What is the date of notice? What is the date of issue of notice? And what is the date of service of notice? There are a lot of judicial precedents where the significant litigation has been drawn, where for counting the limitation period, whether the period will start from the date of issue or date of service. For example, if the assessing officer has issued a notice, signed a notice and kept in his drawer and after a month, he realized that he has issued the notice, but he has not served the notice on the assessee. So whether this kind of scenario will authorize to count the limitation period from the date of issue of notice, which is already lying in the drawer of the officer only and not actually served, or the limitation period is to be counted from the date of service, that is when it is delivered at the doorstep of the assessee. That was the only litigation in the past. But in the E scenario, the number of stages are coming, and therefore the matter has been considered by the Delhi High Court in the case of Sumanjit Agarwal, 143-com, and the different stages which I have explained in my earlier slide. Those are important to consider the challenge from the limitation perspective. Further, Section 282A1 of the 1961 Act mandates that any notice issued by the authority shall be signed. The signing of notice, whether manually or by affixing digital signature, it was essential to consider it as a valid notice. All stages before signing notice will not be relevant for computing the period of limitation with respect to the date of notice. So date of signature is very important. Date of issue of notice refers to the dispatch date. Date of service refers to the day on which it is received by the assessor. And from that perspective, it is important to consider different scenarios, different dates to challenge the validity from the limitation perspective, whether notice is time barred or notice is valid, because that will decide the validity of the emanating procedure proceeding of the assessment. From that perspective, this is important provision to consider the various stages on ITBA portal. So whenever we are challenging certain assessment in the appeal, etc., it is better to scan the entire ITBA portal of the assessee and look on all these stages, and whether there is a clue to argue that the notice is invalid, leading to the invalid assessment. It is very important to, because assessee is not very technically expert, and he will not understand. Even if he is accessing his ITBA portal, he may not be able to note these important points. Therefore, for his chartered accountant, it is necessary to scan this ITBA portal to decide the validity of the notice and different dates of notice, different stages, while considering the validity or challenging the validity ground in the grounds of appeal. Next. Which I was referring to, the Sumit Agarwal's case of Delhi High Court, the various points which have been decided by the Honorable High Court in ERIRA as listed for the benefit of the attendance here, delegates, that it says that mere generation of notice under section 148 on ITBA software cannot in fact or in law constitute issue of notice. It is only upon the due dispatch that the notice can be said to have been issued. Date of issue of notice is not important. It is the date of signing of the notice which is important. Hence, whether notice was dated 31st March 21 but had been digitally signed on 1/4/21, the date of notice will be considered as 1/4/21 for the purpose of limitation period. Where the notices were sent through registered email ID of the respective assessing officer, though not digitally signed, it will be held to be a valid service of notice, and the date and time of dispatch as recorded in ITBA portal will be taken as the date of issuance of notice in this regard. Where the notices were only uploaded on e-filing portal of the SSC without any real-time alert, the date and time when the SSC viewed the notice in e-filing portal as recorded in the ITBA portal will be construed as the date of service of notice. I think this bullet is very important because generally for limitation period, rather than date of issue, the date of service is very important. Then where the notices were manually dispatched, the date and time when the notices were delivered to the post office for dispatch was to be construed as the date of issuance of notice. Where the notices were sent to unrelated email address, date on which the notice was first viewed by the SSC on e-filing portal was to be construed as the date of issuance of notice. These are the important points which one has to take into account. Now, regarding time limit for completion of assessment pursuant to the appeal order, this is one more important change which one has to look, and this is corresponding provision of the 1961 Act is section 150 subsection 1 and section 150 subsection 2, which set the time limit for making the assessment pursuant to a appeal order of the ITAT, High Court, etc. You are aware that under the old Act under section 149, that is sorry, that is section 282 of the new Act, it has been provided that issue of notice for reassessment, the time limit is 4 years from the end of the relevant assessment year or 6 years from the end of the relevant assessment year, depending on the quantum of the escaped income, or 3 years under the Act after 1/4/21, or 10 years as the case may be, where the asset or income is likely to exceed more than 50 lakh rupees. So these are the different time limits set for issue of notice under section 149 in the reassessment regime, which is corresponding to the section 282 of the new Act. Under the old Act, that is 1961 Act, section 150 provided a general time limit which was overriding the time limit under section 149. It means to give the effect to the direction of any finding in the order of the appeal, the time limit prescribed under section 149 need not be followed, but for that purpose, the time limit for section 150 was separately brought on the statute. For example, many times the dispute comes before the tribunal whether the particular escaped income is to be considered for the purpose of AY 24-25 or for AY 1920 or 2021, etc. If the tribunal gives the finding that this is an escaped income cannot be taxed in AY 24-25, it is to be taxed in some other year. Now, the tribunal cannot give the finding. It is my understanding that they can give the finding only for the year which is open before them or before the tribunal. However, if the reading order shows that AO is unable to tax that income in a particular year, but it is possible to tax in the earlier year, then he has to reopen the assessment because of the particular finding or uh, uh, verdict of the tribunal. And for that purpose, he has to reopen the assessment. Now, in normal scenario for reassessment, in the old Act of 1961, for issue of notice, time limit under Section 149 is prescribed. But Section 150 is separately governing the time limit for any finding given in the appellate order or pursuant to the appellate order. So there are two subsections. Section 150 subsection 1 authorizing the AO to issue notice, which is that at any time. So at any time it was a general time limit for the purpose of making the assessment. He can issue the notice pursuant to the order of the appeal. Section 150 subsection 2 has brought restriction on the liberal time limit granted under Section 150 subsection 1, and by providing that the assessment or reassessment can be made provided the original order, which was subject matter of appeal, was not time barred because of the other provisions of the Act limiting the time limit. So meaning thereby, the liberal time limit given under Section 151 has to be read with a caution that the original order which was taken in the appeal was not time barred. So the liberal time limit given under Section 150 subsection was curtailed by Section 150 subsection 2. Now, this general time limit given under Section 150 subsection 1 now has been restricted to the only 3 months prescribed after the receipt of 3 months from the end of the quarter in which the certified copy of the order of the authority or the court is received by the jurisdictional principal commissioner or the commissioner. I think it's very important because otherwise the earlier time limit was very relaxed and the proceedings were becoming unending kind of thing, very long scenario of time limit available to the AO. But now this time limit has been curtailed to the substantial extent, and now only the 3 months have been provided. That is also from the end of the quarter in which the certified copy is received by the principal CIT or the CIT. So these amendments has impacted the time limit under Section 150 subsection 1. It does, according to me, it does not have the impact on the provision contained in Section 150 subsection 2. This is the important change which one has to note. Now, next important amendment is regarding the mistake or omission of DIN. The CBDT by circular dated 14th August 2019 issued by exercising its power under Section 119, where it was made mandatory to quote the DIN on all communications. The provision was applicable for any notices, orders, summons, letters, or any correspondence issued. The circular contained a strict validity clause, meaning thereby, if the notice issued, orders issued, communication, letters, any correspondence issued after 1/10/2019, if the DIN is absent, then that document is not treated as a valid document. Then practically, there were a lot of correspondence, say approval granted by the sanctioning authority under Section 151, or the notices issued in the status of proceeding by the CIT appeal or ITT, etc. Several other cases where the DIN was not quoted, and the circular itself said that it is the authorities have to strictly comply with the quotation of the DIN, and if the DIN is not quoted, then the communication will be treated as a invalid. This was to maintain the trail of the documents, and it was in one sense it was a very welcome amendment as such. But going forward, it has taken to the different litigation. that where the matters were challenged before the courts, that in absence of a DIN, the communication may kindly be held as invalid, and the courts have held in favor of the SEC. The landmark judgment in this regard is a CIT International Tax versus Bandex Mauritius Holdings 149 Taxman, and Kolkata Tribunal has also held that the revision order under Section 263 is invalid, which was issued without the DIN in case of Tata Medicals and Central Trust 140 Taxman. So these were the decisions which are held that if there is a no DIN, absence of the DIN, the communication is invalid, and obviously the emanating proceedings are also invalid. Now, the Finance Act 2026 has amended Section 292BA with retrospective effect on from 110/2019, because 110/2019, that based on the circular which was dated 14th August 2019, it was stated that communication issued after 110/2019. So that circular really, for theoretical purpose, practical purpose, was made applicable from any communication issued after 110/2019. So Finance Year 26 has brought an amendment by amending Section 292BA with retrospective effect, that from 110/2019, stating that in absence of DIN, the communication shall not be deemed to be invalid. Section Finance Act 2026 has inserted Section 522 subsection 2 at par with Section 292BA, which was amended in the context of absence of the DIN. The impact of this amendment will be that it will validate large number of past assessment orders or notices which have been challenged or invalidated solely due to issues related to the DIN. This is the impact of this amendment. Then, apart from the DIN, there is one more amendment, that is whether DSC is appended to the communication or not. In the beginning, I have made some reference to that, but for the sake of more understanding, I am drawing attention to the amendment inserted by Section 292BC. The Finance Act 2026 has been amended by insertion of Section 292BC of the Income Tax Act 1961 with effect from 1/4/21, by inserting the overriding provision that any approval given by the income tax authority in relation to assessment, reassessment, or recompetence, etc., shall be deemed to be administrative and supervisory, and shall not be invalid or shall not be deemed to be invalid by reason of any insufficient of the reasons or reason of defect in the form or the manner of authentication or communication, including whether DSC is appended or not to such approval, where such approval is granted electronically. So they are saying that this is only administrative and supervisory act. So requirement of whether DSC is affixed or not, authenticated by the DSC or not, is not considered as very significant. So I am considering as in a physical scenario that the document is not signed. So it is equivalent to that. If you are not affixing the DSC, how can that document be treated as a valid document? In our practical day-to-day life, if you just send invoice, which is electronically generated or through software to a client, and ask him to pay your fees, he will say it is not signed. He will say that either you sign your invoice by the signature, scan copy to me, or at least you affix the DSC. In a lockdown scenario, many things have been in the tribunal also. Sometimes paperwork were filed electronically, where digitally DSC was used for signature on the forwarding letter or paperwork, etc. Similarly, client insists for the invoice that your invoice is at least you should be digitally signed. So in a normal scenario, this requirement of affixing DSC is considered as a very important in day-to-day practice. And here it's in the legal landscape also. Now the Act is saying that affixing of DSC on the document will not be considered as a lack of approval, etc. And it's only administrative and supervisory. I think it's a matter. We don't know whether it will be challenged further or not. But this is the provision which has been brought by way of amendment in Section 292 BC of that. This amendment is intended to nullify the plea generally taken by the assessee that the approval are granted mechanically, etc. Therefore, this amendment has been brought because if there is no DSC affixed on the approval, etc., then whether the approval has been granted after considering after due application of the mind by the principal CIT or CIT or any other authority, that is the challenge. At least when the DSC is affixed, then one can take it at a par, one can at a face value, at a threshold, that some mind is applied by the approving authority. Whether when there is a no DSC is affixed, then the doubt arises whether the approving authority is just performing the formality of approval or really they have applied the mind. This amendment inserted calling it as a only administrative and supervisory act. The standard is because when you call as an administrative or supervisory act, probably I think the standard is lowered when we call it as a quasi judicial authority, because approval is not a redundant formality. It has some significance from judicial perspective. So it is a judicial act to give the approval. If you are saying that affixing only administrative and supervisory, then we are bringing that threshold of judicial scrutiny to some lower level, which will not be desirable. And there can be we don't know what will the consequences, but this is a fact which the amendment has been brought, and we have to see the implications of that, how it can be challenged in the subsequent proceedings. Uh, obviously, the amendment is brought to provide a legislative shield and ensuring that the electronic approvals are not invalidated when the DSC is not when the DSC is absent. This is the purpose of the amendment. Then some in the some provisions say 153 etc. where the time limit is set for completion of the assessment etc. Say 12 months etc. The time limit has been changed, that using the terminology from 12 months to 1 year, because in the context of I was just looking after the some of the decisions where the wording has been used that the particular act has to be done within 30 days or within a month. There is a Patna High Court decision or Gujarat High Court decision which have said that the mentioning of the days vis-a-vis a month makes a difference. Month means a British calendar, and 30 days means clear 30 days. So days vis-a-vis calendar is making a difference from the perspective of counting the limitation period. Similarly, using the terminology 1 year instead of 12 months, we need to consider the implications of this when we challenge the proceeding from the limitation perspective. This is a small change, but it may have impact on the validity of the notice or order or approval, etc. Because year may be taken as a containing 365 360 days, and so 1 year maybe 365 60 days, while 12 months is a calendar, British calendar, and one has to take the aggregation of the days. It may lead to different result, but there definitely some purpose is there behind this amendment, and therefore this change in the terminology is also important from the considering the perspective of the limitation period. Next. So this was the pertaining to the assessment, etc. Now I coming to the last portion of my presentation, which is related to appeals, and I'm sure we will finish within the time, because fortunately for me, to save my efforts, there are not much changes in the appellate proceedings. So we will finish within 5 minutes, I think, and then we can follow up the question answer session if there are any. So the now section 1961 Act talks about section 246 corresponding section 3 between appealable order by joint CIT appeal, 246A appealable order before CIT appeal, 249 form of appeal limitation, 250 procedure in appeal corresponding section 359, 251 powers of joint CIT appeal or CIT appeal, 252, 252A, 253 appellate tribunal, appeal before the tribunal, 254, 263 appellate orders of the appellate tribunal, rectification by the tribunal, misapplication, etc. 255 procedure of appellate before the appellate tribunal. Next. So these are the sections which one has to note, that old section and new section. Now I have seen that overall, except the change in form number, etc., that earlier form number 35 is changed to something different. So there are the changes, but in some substance, I find that there are fortunately not very major changes, or even not a small changes also, while considering the appellate proceedings, except one, and that is in this slide before you. It says provision regarding avoiding repetitive appeals. You are aware that under Section 1961 Act, there is a Section 158 capital A, which provides that where a question of law pertaining to an earlier assessment year is in appeal before the High Court or Honorable Supreme Court, is identical question of law arising in the subsequent year before the learned AO, then in that case, to avoid the duplicity of the proceedings, it is allowed to the assessee to furnish online application or online declaration that if learned AO or the appellate authority, whether CIT appeal or tribunal, agrees to apply in the latter case the final decision of the court in the earlier case, then the assessee will not file an appeal against the question of law in the latter case. I will explain in the simple terms, because I have practically faced this situation in 2-3 cases. Say, for example, take the controversy whether a particular payment made for software services, whether it's a royalty or not, or say deciding the arm's length price of the intra-group services, etc. The question is coming repetitively every year after year, or say a particular income is the agriculture income or a business income, say income from nursery, etc. The point is, once the AO makes the addition in say 1 year, say AY 8-9, and that year is in appeal before the CIT appeal or before ITAT or before High Court or before Supreme Court. Now CIT appeal or ITAT appeal can be decided because it is they are deciding the facts of the case, and then the matter is carried to the High Court or Supreme Court at the instance of the revenue if they are not satisfied with the decision of the tribunal, or by the assessee if the assessee is aggrieved by the decision of the tribunal challenging the question of law before the High Court or Supreme Court. Then obviously before the High Court and Supreme Court, it takes a long time that question of law will be admitted and the main matter will come for hearing. In between, subsequent year assessments are continued. And AO says that the question of law is pending before the High Court at the instance of the SSC or at the instance of the revenue, and still that is resolved, he goes on continue to make the addition on that point. That in the earlier he has said that it is royalty, we are saying it is not royalty, or he's saying that it is not agriculture income, we are saying that it's agriculture income. So question of law is going on. And every year AO keeps on making addition. We go to CIT appeal, we go to ITAT, or department goes to ITAT, then High Court, then Supreme Court. So there is a endless procedure, even though for the earlier year, the question of law is pending before the High Court or Supreme Court. So the Act has provided a remedy that to avoid the repetitive appeals, you file a declaration before the AO. Some form is prescribed for that purpose. I recollect in the 1961 Act, there was a form number some 8C or something, which was required to file before the AO to give the declaration that facts of the earlier year case, facts of this case, facts of this year are same. Same question of law is arising. I am filing a declaration before the AO. AO has to give this agreement. I mean, he has to concur with the view that same question of law will apply to the facts of the subsequent year case. So whatever the decision by the High Court will be rendered in the first year, that decision will be followed by the, whether it's a for or against, that doesn't matter. It may be in favor of the SSC, it may be against of the SSC, but whatever the decision will be rendered by the High Court or Supreme Court, that will be followed subsequently, and the AO will give the effect in the subsequent year based on the question of law decided by the High Court in the preceding year. This is the procedure of avoiding the repetitive appeals. That means what? Your efforts are saved. You need not to go to CIT appeal. You need not to go to ITAT. And the question of law decided in the earlier year will be followed in the subsequent year, provided the department has to agree that the facts are same, question of law is same. That does not mean that he will not make the addition. He will make the addition. But assessee is saved from filing the further appeals. This is the implication of section 158A. Not only that, he will be competent to raise the demand. He will be able to recover the demand just because you have opted for the modus operandi of 158A for providing the repetitive appeals. That does not mean that you will not make the addition or he will not recover the demand. A recovery of the demand and making the addition is separate. So he may recover the demand, he may not recover the demand. But just because you are filing application and AO is making the addition, that does not mean it's an authority to stop him from the recovery. And that issue has come up before the, I think, Goa bench of the Bombay High Court, etc. And the law is very clear that AO will not be stopped from making the recovery. But assessee's efforts will be saved from filing the appeal before the higher court. Now, suppose at tribunal level, assessee wins the matter. Now it's for the revenue's turn to file the appeal before the High Court. There also the department can exercise the remedy under 158A that they can avoid the circumstances to file the repetitive appeal. That is my understanding. So both are saved and substantial efforts of the assessee and department are saved if this provision for filing repetitive appeals is followed. Now what the change has been brought in this. The amendment has been brought that where the claim made by the assessee is admitted by the learned AO, an appellate authority shall dispose the case without waiting for the final decision on the question of law. In the arrears, the assessee shall not be entitled to raise any question of law in arising the latter case. Now, under this provision, till today, there was no explicit mention about the SLP file against the High Court order. Now, Income Tax Act 25 has now explicitly mentioned that assessee shall not be entitled to raise any question latter case before the High Court or Supreme Court or by filing SLP before the Supreme Court. So this provision has been expanded the scope that it will be applicable to the SLP also. For every year you do not to file the SLP. Whatever the decision of the SLP will be rendered in the earlier year, that will be made applicable to the subsequent year. That is the my understanding of this amendment in the Act, and this is the important welcome change to save the efforts of the repetitive appeals and filing of repetitive SLPs. Next. This is the only change which I have noticed in case of appeal. Now, though there is no much changes in the 2025 Act pertaining to the appeal proceedings, our chairman of the committee, C.S. Shekhar Chitale, has given me the liberty that if there are no changes to discuss in the 2025 Act, I can certainly bring certain important points, if those are worth to mention before the audience, from the present litigation in the case of the appeal. So just for I thought that only 2 points which I was chosen to bring before the audience. The first is whether the adjustment made by CPC in intimation under section 143(1) without providing the opportunity before making an adjustment, because section 153(1) proviso talks about that when the CPC wants to make the adjustment, the opportunity of hearing should be granted to the assessee. Without providing that opportunity, the adjustment cannot be upheld and that intimation is liable to quash. It's a very important provision because whenever we issue the intimation under section 153.1, there are many cases that where they are not giving the opportunity before making the adjustment, they are not calling for the response, and directly they are making the adjustment. Or sometimes they are giving the opportunity, and that is only in a, some at the bottom of the page or etc. And assessee may also be losing that carefully to what is the cause of the adjustment. The second point which I discussed is the fault of the assessee, that they have provided the opportunity, but assessee missed it. There is no question. However, if the CPC has not provided the opportunity before making any adjustment, then the Bombay High Court has held that this is the serious departure from the provision of the law, violation of the law, and in that situation, the adjustment made by the CPC cannot be upheld. That is the Bax India Ventures versus CPC 183-1.com. It is very important because there are many cases where the appeals are coming before the tribunal or the appellate forum when the adjustment are made by the CPC under section 143. So from that perspective, it's a very common point which is applicable in many cases. So I thought it fit to bring it to your notice. Another important point which I thought to bring it to notice, that for when appeal is filed, the question of maintainability of appeal arises. Form number 35, sometimes the adjustment is made under section 143.1. The appellant, through the ignorance of the law or lack of seriousness or lack of proper advice, do not challenge the adjustment under section 153.1. Now, when that case is picked up for final scrutiny for passing the assessment order under section 143.3, assessing officer simply leave that adjustment from 143.1 and incorporate under section 143.3. He says the addition is emanated from 143.1. You have not challenged that under 143.1 in adjustment under 143.1 before appeal. So that has reached the finality. So without going into the merits or demerits of the issue, he simply picked up that addition from 143.1 intimation and made intimation under section 143. There are two kind of arguments. First is whether when my case is selected for scrutiny under 143.3, whether intimation under section 143.1 get merged into 143.3 or 153 separately survived, 143 separately survived. If I don't want addition in 143.3 order, the assessing officer, despite CPC made the adjustment under 143.1, he is bound me to issue the separate show cause at the time of 143.3, whether this addition should be made or called for, or he simply picked up that addition from 143.1 and without issuing show cause, he can make the addition under section 143. So theory of merger or demerger come into this picture, whether that addition is directly made in section 143.3 or every time I have to challenge the adjustment under 143.1 before CIT appeal, then I will get the right to challenge it in 143.3 order. And there are certain decisions which I have quoted in my presentation. There are contradictory rulings. Some rulings have held that 143.1 get merges in 143.3. Some have held that 143.1 separate is liable to challenge. If that is not challenged, then adjustment gets final and that can be simply incorporated under 143.3. So I think these are the important decisions which one need to take into account. This is the second part. The third and the last point, sometimes the CIT dismisses the appeal in form number, looking at some information regarding payment of tax in the form number 35. There is a requirement that in form number 35, you have to give the affirmative answer that where there is you are in appeal, whether the assessor filed a return and tax on return income is paid? Yes or no? If you say no, then your appeal will not be maintainable. If suppose you are not filed a return and you are filing the appeal against the assessment order, then they ask the question whether you have paid the tax equivalent to the advance tax or not. In case the return is not filed, the question arose that when this shortfall is noticed, the CIT appeal without affording any opportunity of hearing, based on this information provided in form number 35, are at a threshold of rejecting the appeal as not maintainable. The courts have held, Karnataka High Court and in Pune Tribunal, etc., that it is not correct on the part of the CIT appeal to dismiss the appeal at threshold. When he notices that the admitted tax on return income is not paid, or when no return is filed, the tax equivalent to advance tax is not paid, there is a shortfall, then CIT appeal for the purpose of natural justice has to issue the notice to the assessee and bring out this fact to his notice that there is a shortfall in payment of tax. You pay the tax, make that shortfall good, and then your appeal will be maintainable. So it's not correct on the part of the CIT appeal to dismiss the appeal at threshold if there is a shortfall in payment of admitted tax on return or advance tax. These are the some of the rulings which I thought that it's necessary to bring to the notice of the audience. With this, one last point. Sometimes the matters are set aside by the CIT appeal or the tribunal to the AO for carrying the DNO assessment, etc. And now, after 110/2024, there is an amendment in section 251 which provides that if the order is passed by the learned one, section 144, that is best judgment assessment, then CIT appeal considering the additional evidence is filed, he can restore the matter for DNO assessment or for the fresh consideration of the matter to the learned AO. Now, when these matters are set aside by the ITT or by the CIT appeal to the AO, the issues are coming that sometimes the effect to this order has been given by the ZAO, and there is a pendency before FAO. That means in faceless record, they show that the effect is to be given to the CIT appeal order or ITT order. Sometimes the effect is already given by jurisdictional assessing officer. Now cases have come that once the effect is given by the jurisdiction officer ZAO, subsequent to that appeal effect order, notice is being received from faceless officer that effect is to be given to the CIT appeal or your matter is pending, you furnish the details. Assessee says that effect is already given by the ZAO, so there is no pendency. In this scenario, whether the action initiated by faceless officer is having a local standing or not, that issue has come up before the Delhi High Court in the case of Religare Securities, which have held that if the effect to the appeal order is already given by the ZAO, then again the FAO cannot exercise the jurisdiction to give the effect to the CIT's order where the matter are restored for the purpose of DNO assessment or fresh consideration. This is the again repetitive point, an important point from my thinking point of view. So I thought that I will bring it to the notice of the delegates. Friends, with this, it's now just 5:55, time allotted to 6 p.m. I think I'm not seeking for the supplementary to attach to my answer paper. Neither I'm running for short of 40 marks, etc. And with this, I'm coming to the end of my presentation. And now I will leave the forum open for the question and answer.
Thank you very much, sir, for such an enlightening, practical, and insightful session. I am confident that all the participants have immensely benefited from your deep analysis and practical perspective on returns, assessment, and appeals under the Income Tax Act 2025. We shall now move to the question answer session. Sir, the main query is about PPT. The technical team will share with the participants. And one query is whether share trading income will be treated as a business and the due date will be 31st August or 31st July. FNO income.
So it's not a question, definitely not a profession.
Okay.
Where is the question of profit? It's not service.
Yes.
At the most, the litigation can be whether it's a speculative business or non-speculative business. But it's a business.
Okay.
And there is a section 43, subsection 5. And I believe there are certain decisions which are held that it's not a speculative. The main point for deciding whether it's a speculative or non-speculative, whether the transaction is settled by way of delivery or not. In case of shares or F&O, or say in case of oil, gold, etc., where the delivery of the commodity has happened or not. That is the only deciding factor. But certainly it is not a profession. It is not a service. The only question is whether speculative or non-speculative. And I believe for the purpose of tax audit, it will make only how to count the turnover. I think there is a ICAI guideline on this, guidance note, and certain decisions also, that the difference between the selling price and purchase price, which have been accounted as a profit or loss in the capital account or in the income expenditure account, that will be considered as a turnover, but not the gross value of the transaction. That is my understanding. And I think there is a ICAI guidance note available on this, so one can check it. But definitely there are certain tribunal decisions also, that what will constitute a turnover for such kind of act. It is certainly not a provision. It is certainly not a provision.
Sir, one last question. Sir, whether provisions of Act 2025 will be applicable to the pending assessment of earlier years in some cases? If so, what are those provisions?
According to me, it's not applicable. The old provisions will be governed by the old law, unless other, because the saving clause is provided, section 522, 536. So as per my understanding, it will be governed by the old laws only. Because there will be challenges for substantive right of the assessee or department, etc. So everything will not be considered as a retrospective as such. This is my view.
One question on trust, sir. In a case of trust where audit is not required by law, but trust deed stipulates audit requirements, what shall be the due date for filing of the return?
But according to me, for the purpose of discussion, where is the exception provided in the Bombay Public Trust Act or etc., that audit is not required?
Okay, sir.
Like for the Companies Act, whether there is activity or not, there is no P&L account, there is only balance sheet. But still audit on the Companies Act is required. So it's a very hypothetical, non-practical question, that audit under Bombay Public Trust Act is not required, but audit just because applicable for the trust deed. Now, suppose, assuming this is the scenario, it says audit applicable under the Income Tax Act law or under any other law.
Okay.
Trust deed is not a, trust deed may be as per frame, as per the law. But if the audit requirement is as per the question frame, if it is only coming from the trust deed itself is not law. It is a document under the law,
Yes,
but
sir.
that is not law per se.
Yes.
Understood?
Yes, sir. Am I audible?
Yes, yes.
Yes. So thank you very much, sir. On behalf of Direct Taxes Committee of ICAI, I extend my heartfelt gratitude to Chitale sir, CA Pankaj Shah sir, and Rajendra sir for sparing their valuable time and sharing their rich knowledge and experience with all of us. I also sincerely thanks all the participants for their enthusiastic presence and active participation. Wishing everyone a wonderful evening ahead. Thank you.
Thank you.
Thank you, sir.
May I leave?
Yes, sir.